Welcome to the Lend Academy podcast, episode number 242. This is your host, Peter Renton, founder of Lend Academy and co-founder of the Lend It Fintech Conference. Today's episode is sponsored by Lend It Fintech USA, the world's largest fintech event dedicated to lending and digital banking. It's happening on our new dates of September 30 and October 1 at the Javits Center in New York. This year, with everything that's been going on, there will be so much to talk about. It will likely be our most important show ever. So come and join us in New York to meet the people who matter, to learn from the experts and get business done. Lend It Fintech, lending and banking connected. Sign up today at lendit.com/USA. Today on the show, I'm delighted to welcome back Ram Ahluwalia. He is the CEO and founder of PeerIQ. Now, PeerIQ has an interesting space in the industry. They're really at the epicenter. They're talking with investors all the time, talking with platforms all the time. So I wanted to get Ram on the show because we're going through unusual times, and I wanted to hear the perspectives he's seeing from both sides. And we talk about his investor clients and what they're seeing, what they're doing, how they're assessing risk today in a very unusual environment. Talk about how the consumer lenders are responding, the small business lenders. We talk about the securitization market and how that's shut down. And we talk quite a bit about the PPP, the Paycheck Protection Program that has just come into place, and much more. It was a fascinating interview. I hope you enjoy the show. Welcome back to the podcast, Ram.
Thanks for having me, Peter.
My pleasure. Okay, so we should give the listeners some context. We're recording this on April 3rd, and we're in a very fast-moving world right now. So as you're listening to this, keep that in context. So maybe let's start, Ram, by just maybe sharing with the listeners what the past couple of weeks have been like for you personally and what they've been like for PeerIQ.
Sure. The last 4 to 5 weeks have been extraordinary, I'm sure, as they have been for your listeners also. Personally, my wife, who's a software engineer at Bloomberg, we're both working from home. Daycare's shut off, so we're doing what we can to shuttle our little guy back and forth and get work done, and also lead for our organizations. From the company perspective, the first week of March, we had a call over the weekend when we saw coronavirus cases were growing. In New York City at the time, the case count was very low, but it was clear that this was an exponential. You could look in other parts of the world, such as Italy, and the view was we're all going to be working from home virtually at some point. The question is when. And this is a freight train. We'd rather get out of the way and anticipate and have some semblance of control rather than be forced inevitably through an appropriate government policy. Mm-hmm. So to that end, we implemented a virtual work from home training. We adopted a set of best practices and tools, codified that in a document. We had optional work from home the first 2 weeks. Within 3 days, everyone was working from home except for one super trooper holding the fort. So the second component of that was customer reassurance as well. This is really getting to mid-March. So once we were effectively executing remotely, which is difficult if you have a data analytics business, but I think we've maintained our productivity levels. We focused on customer reassurance, letting them know that we're here to help them and serve them. Fortunately, we had our first year of cash flow positivity last year, which was great, and doing the best we can to help them manage risk. I think the one area that's been disappointing is on recruiting, of all things. We had two candidates, one from a top 4 consultancy, the other from a blue chip credit card company in New York, you can probably guess. And both of them said, look, they just want to kind of stay where they are and not take the risk of moving to a startup. Mm-hmm. So that's been our experience.
Right. Okay, makes sense. So you're in an interesting position here with with being a data analytics company, and the data that is coming out has been, I'm sure, just kind of unprecedented. But before we get to that, I'd be curious to hear about you work with a lot of investors, a lot of large investors. I've spoken to several over the past week. What are you hearing from your investor clients?
Sure. So investors are finding that financing loan purchases is difficult. So in the QSIP market, and you're seeing this roll down back to the originators, right? In the QSIP market, it's very difficult to roll over your positions. QSIPs are financed through overnight repo, and also haircuts are increasing. So, it's simplistic, but I think a fair analogy, you can kind of think of it like a margin call. You have to be able to, you need the ability to fund your QSIPs, otherwise you're not going to be able to extend and buy new loans. So credit facilities in some cases are being tapped out or canceled, citing material adverse conditions. Investors are enjoying incentives. So some lenders are sharing in the origination fee with investors or selling loans below par so they can capture some kind of revenue. There's obviously a big uptick in the need for data and analytics. We're in a risk-off world. This is a risk management problem now, so doing what we can to help them. On the lender side, lenders are raising rates. You saw a few days ago, Lending Club has raised rates. Everyone has to in order to make this an attractive product for investors. Mm-hmm. Lenders have cut back. In general terms, they've cut back substantially. Some of the larger lenders, definitely in the double-digit range, call it 40, 50%. Some other lenders, I've seen 90%. I haven't seen lenders fully shut off. There's definitely been tightening in underwriting by industry type. I think most of that tightening goes back to capital availability mm-hmm. more than anything else. Mm-hmm. There's also concerns that lenders have that consumers in this barrage of information might choose not to pay their consumer loans, confusing mortgage forbearance, for example, with the need for them to continue to pay their consumer loans. There are some bright spots. One lender has had a record origination month last month. They finance products. I can't name the product they finance, but it's a niche seller, and it's kind of the type of product that people buy during times of stress, not toilet paper.
Right. Okay. So then one of the things that I think is really interesting about today is that, there was a quote from Jared Hecht, who's going to be on the podcast next week, but he was a quote in the Wall Street Journal earlier this week, basically saying, no one knows how to underwrite risk in today's climate. And so what are you seeing, and what you're a data and analytics company? What is I feel like this is this is unprecedented. But how do you help your clients model risk today?
Yeah, it's absolutely unprecedented. You saw that in the last 2 weeks we lost 10 million jobs. The right. Unemployment rate's ticking up. We probably have another 10 to 15 more million jobs that will be lost. So yes, that said, I think there's a split between small business and consumer mm-hmm. risk. Small business, kind of an obvious statement, they will experience substantial losses, particularly those sectors that are most exposed to the crisis, travel, retail, and so forth. Consumer, I think, will actually do better than most believe due to the tremendous policy response that we're seeing. There will be losses that take place. Some of that will be attributable to the lack of plumbing and orderly distribution of benefits. Websites being down for unemployment insurance, or some of the challenges even in the PPP program, which will impact employment levels. So on the consumer side, I think you can still go out there and underwrite. Small business, though, is no question, it's extraordinarily challenging. From a consumer perspective, you can use the loan level data. You can map that to geographic state-by-state unemployment benefits, which matters. You can layer on the federal benefits. You can identify where there's been mortgage payment or rent relief. So you can do the math at that level and I think do a robust, bottoms-up assessment.
Okay. So then what about other data points? I'm curious, what are maybe some of the things that you haven't mentioned yet that you could that could be a good indicator of risk right now?
Sure. So this is primarily a health issue that has become an economic issue. So, certainly the hospitalization rate for coronavirus cases is a good metric to look at. It's not biased from the dispersion and testing that we're experiencing. So that's number one. Second, weekly unemployment claims is a very good one. Generally, that's a lagging indicator. In March 2009 was the highest month of job losses. It was also the first month that started the recovery. But this is an unusual time period where leading and coincident indicators are generally on top of each other. So that's a good one. In terms of real-time data, obviously looking at real-time delinquencies on risk platforms such as ours, looking at delinquencies through servicer reports. If you have more exposure to non-prime risk, I would recommend looking at the monthly remit report from OneMain, which has been around for over 100 years, to get a good sense about how that population is performing. If you have prime credit risk, I would look at data from the credit card, Master Trust, ABS programs. And then I would also focus on just asking questions around market functioning, because some of the challenge with the past 4 weeks is that certain markets have stopped functioning normally. The repo market, the municipal bond market, the risk of not being able to roll over investment grade debt. Fortunately, there's been so much action and firepower that the Fed and Treasury have taken that I think most of those issues have actually been addressed, but it's something to keep an eye out on.
Mm-hmm. Sure. Okay. So then, and one of the markets that's also closed off is the ABS markets. They're really, there's no one can get a securitization closed right now. What impact is that going to have on, particularly on the consumer and student lenders?
Well, it means less ability to originate because the channel that can deliver, scale funding securitization is shut off. So you have to, find other pillars of capital to lean on. It's extraordinarily challenging. Securitization relies on a gain on sale model, and right now lenders are selling loans at below par. Mm-hmm. So some lenders are in a negative unit economics position. Warehouse lines are pricing wide. Sometimes the securitization markets, in Q1 2016, we saw certain lenders go to securitization markets anyway, just so they could clear out the facilities and originate loans and capture an origination fee. This market shut down so fast and swiftly, they were unable to do that. So it means higher rates for consumers, higher rates for small business. I think the other takeaway is that it's abundantly clear that fintechs and non-banks need to find a distribution channel to banks. Mm-hmm. Absolutely clear that has to be the case. Yes, there's a very important role for institutional investors and providers of term capital like private equity. Someone needs to take on the first loss position and enable credit extension to riskier or underserved credit segments. But the primary challenge is that there's no clear ability for fintechs to distribute loans to the banking sector.
Right. And on that, I was actually speaking with someone at one of the consumer lenders earlier this week, and they said, the institutional investor channel is basically closed. There's really very little money coming. But he said the banks and credit unions are continuing to invest. Is that what you're seeing across the industry?
Yeah, institutional investors have a couple different stripes. Some are committed to the category. So they will reinvest principal and interest, and they'll take advantage of these incentives. Mm-hmm. I would also say that there's some players that are in a really beautiful spot. For example, like a Cross River Bank, where they are a commercial bank, and they're also a partner funding bank, and therefore they may be able to benefit from some of these programs that are launching and help provide liquidity, in different kinds of ways. But yes, overall, if you're an investor and you're looking across capital markets, from a relative value basis, why wouldn't I buy a bond that has a comparable coupon after you adjust for losses, but also has assets and have recourse to the entire company's balance sheet? Mm-hmm. So investors are behaving rationally. And it's, I think that's a main lesson. What we learned in this crisis is that when losses are going up and unemployment is increasing, the only mechanic to enable markets to clear is for loans to trade below par or for lenders to give up a portion of the origination fee. Now, that's not a sustainable business model. Mm-hmm. So you have to open up distribution to banks and credit unions. they recognize they don't have technology. They recognize they don't have a first-class customer experience. They also have access, particularly the smaller credit unions and smaller banks, where I think this is most relevant for, to trillions in deposits.
Mm-hmm. Right. Okay, so I want to get back to securitization because I've been seeing some ratings agencies emailing this week talking about potential downgrades of some of the existing transactions that are out there. What are you seeing on that front?
Yeah, there's Kroll put 10 small business ABS deals on negative ratings watch. They're the most active ratings agency in the marketplace lending space. They have not put any NPL bonds on downgrade or negative ratings watch yet. The ratings agencies are going to wait to look at what the April remit reports look like, and then they'll take action from there. So we'll see. I mean, it's just going back to the policy response. It's been fast and swift. The mechanics have been a bit disorderly, but the policy response should enable the vast majority of consumers, both W-2 and 1099, to bridge through at least the next 10 weeks, and then we'll reassess at that point in time, right? The policymakers in DC have made it clear that this is an installment approach to the crisis. So it's not clear that consumer NPL bonds will experience the kinds of losses we saw in 2008, even though the unemployment rate and the number of job losses will likely eclipse that.
Mm-hmm. Yeah, because I mean, if we can get the stimulus out, I guess that there will be, people will have some money, and I mean, there's been talk. Honestly, there's talk about a fourth package that's coming up, and maybe let's just talk a little bit about that because today we're. This is the official launch of the Paycheck Protection Program, and we're recording this sort of halfway through the day, and it hasn't gone smoothly right now. While there is some loans that appear to be going through. There's like Bank of America is the only one of the big banks, and they have strings attached to their loans. So, originally when I thought this was coming up, I thought this was going to be fintech's time to really shine, but I'm unaware of any fintech that has been approved yet, and that is part of this. So, what are you hearing about the PPP?
Yeah, no, you had a good write-up on it this morning. I think there are a couple of opportunities and challenges. So the SBA lending program last year was about $23 billion in size. For this program to be effective, the fintechs are essential to help originate loans. And the provider of capital is the major issue. That provider of capital, as we discussed earlier, has to be the banks in order to make the economics work. Mm-hmm. You saw that Treasury Secretary Mnuchin upped the interest rate on these PPP loans to 1%, which I thought was a good move. I would actually suggest it go a bit higher to 1.5%, so that you can motivate banks to profitably, fund these loans and hit their ROE objectives. So that's one challenge. The second is it's not clear who will bear the responsibility for rep and warranty violations or fraud claims. Mm-hmm. On the one hand, the policymakers have erred on the side of maximizing response and trying to move as fast as they can. At the same time, banks are held to a high standard. So think here about know your customer rules, anti-money laundering rules, Bank Secrecy Act rules. So they need some type of guideline or safe harbor. And without that, I don't think you're going to get much uptake. From the big banks that I reached out to and polled, most will initially focus on their customer bases today. I think it's a huge opportunity for fintechs, except fintechs need to be thoughtful about their origination process, meaning we'll look back at this a year or 2 years from now and we'll measure what were the fraud rates. And if fintechs apply a set of standards that banks hold themselves accountable to, except they do it better, faster, and cheaper, then we'll be building the case for regulators that this temporary channel that is linking fintechs to the banking sector should become a more permanent channel. Mm-hmm. But you're right. There are definitely key issues to work through. It looks like they're aware of it. They're on it. And hopefully next week we start seeing loans printed.
Yeah, that's the plan. I mean, I've we're here at Lend It, we're applying, and we've been in touch with our banker. They're saying Monday is we should be able to apply. And I spoke with a couple of fintech companies this week. Actually, I spoke with several, and one said that they really want to be on board. They're applying to be approved, even though it will be a loss-making product most likely for them. But they just they want to be part of the solution. Another said they can't make it work. It's just where it is right now. The economics are just simply not viable. So. I think maybe we'll see some changes down the road, but I mean the thing that we haven't seen yet is I mean I feel like we're still in the early innings here. We're going to have, once we get every bank out there that's open, then we're going to see, well, okay, how long is this going to take? Are people really going to be approved instantly? I mean, our bank has said that you can only apply online, which I think is good, but and it's a pretty simple form. And given that we have an existing relationship, I think that's what most people have to do. They have to go to their existing bank. So, I mean, that leaves fintechs out in the cold a little bit. But I feel like, maybe. It's always possible there'll be a second round here, or there'll be a rejigging of the rules, because I feel like I originally thought this was fintech's time to shine, but. It may not be, but I know it's hard to stare into a crystal ball in a time like this, but how do you think the small business lenders on the fintech side are going to be able to get involved?
Most of them have expressed interest, at least the ones I've kind of informally polled. The economics on the origination fee, as you know, are up to 5%.
Yep.
And with a loan interest rate at 1%, there's definitely a workable business model there. And there are definitely very prominent small business originators that are focused on, developing, an origination machine around that. I think the regulators are improvising swiftly.
Right.
So if we're seeing that the take up on the PPP program is falling short of the goals to get in the, call it, $347 billion range, you're going to see more permissiveness. And so I do think that, this actually is a good opportunity for the fintechs to shine. It's probably the fintechs that are linked or partnered with a partner funding banks,
right,
that are in the best position, because, if you're across river, you have oversight over compliance, customer disclosures, and you yourself are held to bank standards. So that, intermediation function, that stamp of approval function, could be, an important conduit to help these small business, fintech originators deliver loans into the banking sector.
Right. Yeah, I certainly hope that we're able to come in here. But I mean, if you don't have like pretty much every fintech lender, and not everyone, but on the small business side, has a banking relationship. So the challenge, if they might have a banking relationship, but they don't have, their cost of capital is going to be greater than 1% in a lot of these situations. The origination fee is enough that you can, that provides certainly some cash flow up front. But do you see any outside investors other than banks, going to take up this
no
this proposition?
It has to be the banks. It has to be the banks in order to make the economics work and the supply of capital. So the fintechs will focus on origination and servicing, and then selling the asset to some banking institution, and potentially sharing the economics through multiple different ways to motivate the banks to buy these loans. So that, those pipes need to get built. They need to get worked out. There are a lot of issues around that. We touched on some of that earlier. If you're a bank buying loans from a thinly capitalized fintech, and you're buying billions and tens of billions of loans, but the fintech has maybe tens of millions in equity capital, then how do you enforce your reps and warranties if there are applications that down the road did not conform with the policy of the PPP, right?
Right.
For instance. So those are some of the challenges, but there's no question you need to have distribution built out for banks. The fintech market does not have the balance sheet to absorb this.
Right.
And also the mechanic around loan forgiveness needs to be spelled out so banks can plan, and the mechanic on how banks can put that risk to some other buyer needs to be clarified as well.
Right.
Presumably the Treasury.
Yep. So another thing that speaking of Treasury and I wanted to talk about another piece that came out. I think it was actually not this week, but last week, was the Fed reestablished the Term Asset-Backed Securities Loan Facility, TALF, it's called. And it basically, this was something that they started in 2008 in the financial crisis, and they did not include personal loans. I mean, obviously there's student loans, there's auto loans and credit cards and that sort of thing. But what are your thoughts on TALF, and can we get this changed to include consumer loans?
It's an extraordinary program. It was very effective in 2008. And essentially what TALF enables you to do is unclog funding markets for high quality assets. As a participant in the TALF program, you can borrow at the same rates, essentially at the federal government, without recourse. So it's an extraordinary program. So the challenges we talked about earlier around the QSIP market and the credit facility market could potentially be addressed with the TALF program. Now, TALF in the 2008 market was scoped to focus on investment grade and rated securities. Personal loans in a loan format obviously don't meet those criteria. So we need to think about how to make that work. It's, one way to do that would be to have essentially a credit facility that's provided by the Federal Reserve and have eligible collateral rules that govern the haircut and advance rate. It's much in the same way that investment banks provide funding to fintechs. In fact, I think the proper way to do it would to enable the investment banks to fund via their primary dealer credit facilities through the Federal Reserve. That's the cleanest way to do it, because then you also have all the machinery around monitoring and the contracts and the due diligence in place too. But I think that's the way to make it come together.
Right. Okay, we're running out of time, but a couple more things I really want to get to. There was some interesting talk. An earlier version of the CARES Act had a digital wallet of sorts, a Fed account, they called it, where basically it could be money could be distributed to people without bank accounts, and you could have a direct account with the Federal Reserve. So, do you think we're closer to a central bank digital currency now than we were a month ago?
Absolutely not. I think that's a zero, right? The central banks and policymakers are putting out fires. To design and deploy a central digitized currency requires a lot of thoughtfulness and planning and comment period. It also disintermediates the banks that would object to that. It doesn't mean that it's not a good idea. I don't think it's a priority for anyone to focus on that at this point in time. Right.
It's something that it's surprising for me to see it. This is something, if you had it already, you would certainly take advantage of it. But this is probably not the time to
It's cute. It's cute. It's novel. It's interesting. If people have a couple extra hours from work from home, they can kind of write about it and kind of do the simulation of what would have happened if we had this. But, if you look at the digital currencies out there, they're not doing too well either, although this is, serving a different kind of purpose. I think a better response is what you saw from Chime, where they're enabling, rapid account openings and enabling the efficient disbursement of these direct payouts and funds to, impacted individuals. That's a far more practical industry response.
Yeah. I completely agree. Okay. So then, at the risk of, obviously being out of date by the time this publishes, what are some of your closing thoughts here about where this is going and how we are all going to come out the other side?
Sure. So I think the mantra here is don't let a good crisis go to waste. There are three themes here. One is the acceleration of digital is happening. In some cases, it's happening by law. as you pointed out, regarding the applications for several of these programs.
Mm-hmm.
So that's a long-term trend in the favor of fintechs. Second is service your customers, engage with them. Don't take loan payments for granted. Customers are getting the deluge of information. You need to engage and service them. Third is hold yourself to a higher standard. So if you have the opportunity to originate loans and sell them to a bank and capture an origination fee, aim for the same kinds of standards that banks hold themselves to in terms of fraud and anti-money laundering, and know your customer. Because if you can do that, you can win the long game of opening a more permanent, reliable channel to distribute loans into the banking sector, which is a natural marriage.
Mm-hmm, mm-hmm. Okay, we're going to have to leave it there, Ram. I really appreciate you coming on the show today.
Thank you, Peter. Have a good one. Take care.
You too. See ya. One of the things I think is interesting, and Ram touched on this, and that is the difference between the small business lenders and the consumer lenders. Now, many small business lenders have just stopped lending completely. Because so many small businesses are dormant, are just not operating right now with no revenue coming in, and it's just very, very difficult to underwrite small businesses. Now, whereas consumers, none of the consumer lending platforms, or none that I know of anyway, have completely shut down their lending. Many, or I'd say most, have tightened their credit box, some considerably. But it just points to, I think, the different kind of perspectives we have. And the consumer is, while many of them are losing their jobs, many of them also have savings, particularly the more prime consumers. So you're probably not going to see as big of a shock on the consumer side as you are on the small business side, particularly until we start to see the Paycheck Protection Plan, the PPP, until we start to see those funds flowing readily to all the struggling small businesses. Anyway, on that note, I will sign off. I very much appreciate you listening, and I'll catch you next time. Bye. Today's episode was sponsored by Lend Fintech USA, the world's largest fintech event dedicated to lending and digital banking. It's happening on our new dates of September 30 and October 1st at the Javits Center in New York. This year, with everything that's been going on, there will be so much to talk about. It will likely be our most important show ever. Come and join us in New York to meet the people who matter, to learn from the experts and get business done. Lend Fintech, lending and banking connected. Sign up today at lendit.com/USA.